Good morning, good afternoon, good evening, wherever you are in the world today. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies, providing independent financial advice and private wealth management to airline pilots from all carriers since 2004. We give you the tools and advice you need to take advantage of the ever-changing financial world and help you take care of the business end of your professional aviation career. Thank you for tuning in to our podcast channel, bringing you up-to-date, relevant, independent information so that you can make sound financial decisions for yourselves, your family, and your eventual retirement from the airlines. Don't forget to hit the subscribe button so you can stay up to date on any relevant and timely information we bring to the professional aviation community. Welcome to the Pilot Money Podcast. Today is June 1st. It's Wednesday. It's about 2:30 in the afternoon, and the markets have about 30 more minutes to go for the day. Looking at all the charts here, looks like we're going to be in the kind of flat for the day. I don't see too much changing in the next 30 minutes or so before it closes. But I wanted to put out this video, and I wanted to wait till today. I wanted to wait till the month of May was over so that we can kind of analyze what's been happening and during the month of May, which is such an extreme month, and also talk about a couple of things that you can maybe do during volatile periods like this to maybe help you play a little bit of offense instead of what may feel like you're always kind of playing defense when you have such volatile times in the stock markets. And also, we're going to talk about certain techniques that we use that you may also be using already and may not necessarily know about it. And we're going to talk about what we call dollar cost averaging. So thanks for tuning in. Let's go ahead and get started. So I decided to do this segment because of the Memorial Day holiday that we just came back from, because it reminded me of a guy named Harry Markowitz and his contributions to the financial industry. He was a statistician for the U.S. Army, and he was instrumental in the successful deployment of our fleet to the European coast during World War II. In short, he used what today we call asset diversification, but back then he did it with our naval fleet. After he left the Army, Harry Markowitz became an economist, and he applied his theories to the financial world and developed something that we call today modern portfolio theory, and he did that back in 1952. And basically what he did, he has fundamentally changed the way that people and institutions invest. In fact, he won a Nobel Prize for it 40 years after the fact, after introducing us to modern portfolio theory. And I can tell you one thing for a fact, market timing was not part of that theory. He knew that no one could deliberately time the market correctly and consistently on a repeated basis. However, Harry Markowitz did show us how we can take advantage of volatility and potentially getting the same, if not better results than correctly timing the markets with a whole lot less risk. And it's called dollar cost averaging. Dollar cost averaging is a simple technique that entails investing a fixed amount of money in the same investment at regular intervals over a long period of time. In fact, if you have a 401k right now and you're participating in it, you're actually already using this strategy, but you just may not have known about it. Okay, so let's break it down. How do you invest using dollar cost averaging? Well, implementing the strategy is actually pretty simple. You invest the same amount of money in the same investment at regular intervals, let's say bi-monthly, monthly, bi-weekly, whichever one you want to do, and you completely ignore the fluctuations in the price of your own investment. Whether it's up or down, you're putting the same amount of money into it consistently. By the way, if you happen to own a stock that pays dividends, reinvesting those dividends back into the stock itself is actually accomplishing the same exact thing. But basically, the number of shares that you purchase each month will vary depending on the share of the investment at the time of the purchase. When the share value rises, your money will buy fewer shares per dollar invested. When the share price is down, your money will get you more shares. Over time, the average cost per share you spend should compare quite favorably with the price you would have paid if you had tried to time the market and were actually successful at trying to do so. But in the long run, this is a highly strategic way to invest. And since you're buying more shares when the cost is low, you're reducing your average cost per share over time. And we call this lowering your cost basis. Assume an investor deposits $1,000 on the first of each month into an investment we'll call XYZ beginning in January. Now, like any investment, this investment bounces around in price from month to month. In January, let's assume that XYZ was trading at $20 per share. By February 1, it was at $16 per share. By March 1st, it was $12 per share. In April 1, it was $17 a share. And by May 1st, it was $23 per share. The investor keeps steadily putting $1,000 into the investment on the first of the month, while the number of shares that amount of money buys actually varies. For example, in January, $1,000 bought 50 shares. In February, it bought 62.5 shares. In March, it bought 83.3 shares. And in April, it was 58.2 shares. And finally, in May, it was 43.48 shares that $1,000 bought. Now, just 5 months after beginning to contribute to the fund, the investor now owns 298.1 shares of the specific investment. Now, the average price of those shares is $16.77. Based on the current price of the shares, the investment of $5,000 has turned into $6,857.11. If the investor had spent the entire $5,000 at once at any time during this period, the total profit may be higher or lower, but by staggering the purchases, the risk of the investment has been greatly reduced. Now, dollar cost averaging is definitely a long-term strategy. While the financial markets are in a constant state of flux over long periods of time, most stocks tend to move in the same general direction, swept along with the larger currents of the economy. This is why, regardless of the amount of money that you have to invest, dollar cost averaging has to be a long-term strategy. Now, in addition, market investments don't, as a general rule, change in value drastically from month to month. You have to keep your investments going through the good and the bad times to see the real value of dollar cost averaging. Now, over time, your assets will reflect both the premium prices of a bull market and the discounts of a bear market. Now, if you happen to want to start a dollar cost averaging strategy for yourself, obviously this is a good time to start because the market is down. Now, for those of you who we manage 401ks for at the airlines, whether you're a pilot or flight attendant or any other kind of employee at the airlines, we're already doing this for you. Every time you make a contribution to your 401k, we are deploying those funds for you into your portfolio on a systematic basis. We go a little bit of a step further, where we actually are more selective of where the monies go, but we're still dollar cost averaging into your account. If you happen to be maxed out in your 401k and you happen to have some extra cash that you want to deploy, again, this is a great time to do it. So give us a call. Happy to help you out in any way that we can. Once again, my name is Alex Tapia, President and Founder of Aviation Retirement Strategies and ARS Private Wealth. Thanks for listening, and we'll see you next time.